Uber announced its Q3 earnings yesterday. It keeps picking up pace, adding users to its platform, but it continues to lose money. Amongst food delivery and mobility companies, Financial Pro searches for Uber come in every month at nearly 2 times the closest competitor on Trackstar, our proprietary stock search database. Wall Street reacted well to Uber's financial report as the company continued its slow pivot from burning to generating cash. Shares are up more than 50% from their June lows, but are still down more than 50% from their 2021 highs. So what are investors to make of this company? Like many tech startups, Uber had explosive growth over the last 5 years. The firm went from $7.9 billion in revenues in 2017 to $17.4 billion in 2021. And Uber has $4.4 billion in total cash and $11.4 billion in total debt. Despite this imbalance, its current ratio of 0.98x indicates that the firm has liquid capital to meet its short-term liabilities. Uber isn't yet profitable and therefore has no PE gap ratio. The same is true of several of its competitors. Many of these firms follow the same business model of growing their user bases and figuring out monetization later. This model worked well in a near zero interest rate environment where money was essentially free. But as rates rise, the focus needs to shift to becoming profitable. Uber trades at a price-to-sales ratio of 2x, which is mid-range amongst its peers, and its gross profit margin follows a similar pattern. However, Uber's net income margin of minus 39% is comparatively weak. Only Uber and DoorDash generate cash from operations, the rest burn through funds. Return on equity is also troublesome. Again, this is a reflection of putting growth ahead of profits. And Uber has grown at a blistering pace. Q3 revenue growth was 72% from the same quarter last year, and its full-year revenue growth of 99.4% year-over-year is notably higher than its competitors. The closest is Lyft at 51.4%. In our opinion, this is a 6 out of 10 ranking stock. Uber is a fast-growing company that's made its presence known worldwide. And while it isn't yet profitable, it does generate positive cash flow, a recent step that's critical to the company's future. Uber faces heavy competition from traditional retailers like Walmart, Domino's Pizza, and Amazon, who can take market share away from Uber's delivery business. And it faces similar risks if autonomous driving comes to fruition. Nevertheless, it's in a better position than its peers in nearly every category, and the advertising business adds a critical dimension that, although speculative, could transform the company. That's why we think Uber is a good speculative play that can be bought on dips so long as an investor manages their capital appropriately.